This morning the world woke up to a tidal wave of breaking news. Headlines blazed across television screens and smartphones everywhere. Oil prices plunge overnight, global markets in turmoil. The sense of urgency was unmistakable, as newsrooms scrambled to cover the unfolding crisis, and people everywhere paused to take in the shocking updates. Almost simultaneously, another bombshell hit from the east. News broke from Beijing. China's stock market crashes, trillions wiped out. The Shanghai trading floor erupted into chaos, with traders frantically trying to make sense of the sudden collapse. Financial tickers in Mandarin scrolled relentlessly, each update more alarming than the last. Around the globe, people watched in disbelief as red numbers flashed across monitors. Falling graphs and plunging indices became the new normal, and investors everywhere stared at their screens, unable to look away from the unfolding disaster. In the world's financial capitals, from New York to London, traders stood frozen in disbelief. The news of collapsing oil prices sent a wave of panic through the markets, with brokers scrambling to respond as the value of assets tumbled. The usually bustling trading floors were now filled with tension and uncertainty. It felt as if the world's biggest economies were stumbling all at once. International financial districts, usually symbols of stability and growth, now looked tense and vulnerable. Major city exchanges, from Tokyo to Frankfurt, showed signs of stress as the crisis deepened. Oil, often called the lifeblood of modern industry, had suddenly become cheaper than anyone could have predicted. Storage yards filled up as demand evaporated, and digital charts showed prices in freefall. The energy sector, once a pillar of economic strength, now faced an uncertain future. At the same moment, China, the workshop of the world, was hit by its worst economic crash in decades. Factory workers looked on with concern as production lines ground to a halt. Entire industrial zones, once bustling with activity, now stood eerily silent and deserted. News anchors everywhere struggled to find words strong enough to describe the situation. Phrases like chaos and disaster dominated the airwaves as dramatic banners flashed across screens. The sense of crisis was palpable, and the world watched, transfixed by the unfolding drama. Financial experts and economists appeared on news channels, their faces etched with worry. Heated debates broke out among analysts, each trying to predict what might come next. The uncertainty was overwhelming, and no one seemed to have clear answers. On social media, confusion and fear spread like wildfire. Crisis hashtags trended worldwide as people shared alarming posts and tried to make sense of the chaos. Every new update seemed to bring more questions than answers. Across cities and towns, people posted pictures of empty supermarket shelves and shuttered shops. Families worried about paying their bills, and small business owners faced the painful reality of closing their doors. Office workers packed up their belongings, uncertain if they would return. Everywhere, from kitchen tables to government offices, families, business owners, and leaders asked the same urgent questions. How did this happen? What does it mean for our jobs, our savings, and our future? The world was left searching for answers, united by a sense of shock and uncertainty. Why oil prices matter everywhere. Oil is often called the lifeblood of the modern world. It powers our cars, heats our homes, and keeps factories running. But what happens when the price of oil suddenly changes? That's when we experience what's known as an oil shock. An oil shock happens when oil prices change very quickly, often in a matter of days or even hours. These changes can be triggered by global events, political tensions, natural disasters, or shifts in supply and demand. This can be a sudden rise, where prices skyrocket, or a sharp fall, where prices plummet. Either way, the effects ripple through the entire economy. Oil shocks are important because oil is used for almost everything: cars, planes, factories, and even making plastics, medicines, and everyday products like packaging and clothing. Nearly every industry depends on oil in some way. When oil prices move fast, the costs of transport and goods also change fast. Shipping companies, airlines, and supermarkets all feel the impact, and these costs are often passed on to consumers. If oil becomes expensive, companies spend more to bring products to stores. This can lead to higher prices for everything from groceries to electronics, squeezing household budgets. Plane tickets and food prices can rise, making travel and daily living more costly for everyone. Inflation can speed up, and people may cut back on spending. On the other hand, if oil becomes very cheap, energy companies may lose money, cut jobs, or even shut down. This can hurt communities that rely on oil jobs and reduce investment in future energy projects. Countries that sell oil can become unstable, if prices fall too low, affecting millions of people. Governments may struggle to provide services, and social unrest can grow. Oil is traded across the world, so a shock in one place spreads quickly. A price change in one country can influence economies and markets everywhere, from Asia to Europe to the Americas. For example, if oil prices drop in the Middle East, energy companies in the United States, Nigeria, and Russia also feel the effects. Jobs, investments, and even government budgets can be affected. This is why oil shocks are everyone's problem, not just for oil companies. Whether you drive a car, buy groceries, or simply use electricity, oil shocks can change your daily life in ways you might not expect. China is the world's second-largest economy. It makes many of the things we use every day: phones, clothes, electronics, toys. When you buy something in a store, there is a good chance it was made in China or used Chinese parts. Factories in China work with suppliers around the world. They need raw materials like oil, iron, and copper from other countries. China buys food, fuel, and machines from other nations. In return, it sells finished products. This web of buying and selling connects China to nearly every country. If China's economy slows down or crashes, companies everywhere can lose business. Farmers, miners, and even car makers in faraway places may lose customers. China is also a big investor. Chinese banks lend money to governments and businesses in Africa, South America, and beyond. When China faces trouble, it can stop investing or buying, causing problems for many nations. This year, oil prices fell quickly. One reason is that new energy sources, like wind and solar, are growing fast. Another reason is that some countries are pumping more oil than the world needs. When supply is higher than demand, prices drop. After years of high prices, some oil-rich nations now face big budget gaps. Companies that explore for oil have cut jobs and spending. At the same time, China's economy slowed sharply. Factories closed as people bought fewer products. Some large property companies went bankrupt. Investors lost trust in China's stock market, causing a crash. As people spent less, shops and restaurants closed, putting millions out of work. Falling oil prices hurt countries that sell oil to China. China's crash hurt companies that sell goods or materials to Chinese factories. The two crises fed off each other, spreading worry across the globe. When an oil shock and a China crash happen at the same time, the problems multiply. Cheap oil should help countries that buy oil, but if China is buying less, demand drops even more. Countries that depend on selling oil lose money twice, first because of low prices, and again because China is buying less. Companies that sell to China see their profits fall. If they also depend on energy sales, their problems grow. Financial markets react with fear. Investors may sell stocks or pull out of riskier countries, making it harder for those nations to borrow money. Banks worry about unpaid loans. Small businesses close as people spend less. Governments might have to cut spending, causing even more pain. A double crisis like this can push the world into a deep recession, where growth stops and unemployment rises everywhere. For ordinary people, a global economic disaster really changes daily life. Some may lose their jobs if factories close or companies cut costs. Prices in stores might go up for some goods and fall for others. Travel could actually become cheaper if oil stays low. But, families may have less money to spend. Many people start to worry about their savings. If the value of money drops or banks have trouble, it can be hard to pay for school, rent, or medical bills. Young people might find it tougher to get their first job. Parents may worry about providing food and shelter. Even those far from China or oil-producing countries can feel the effects. Global companies might stop hiring or lower wages. Governments could raise taxes or cut public services to balance their budgets. This is why a crisis in two distant places can touch lives everywhere. Imagine a farmer in Brazil who grows soybeans on his land, working hard every season to harvest a good crop. Most of his soybeans are shipped overseas, especially to China, which is one of the world's largest buyers. When China's economy is booming, demand for soybeans is high, and the farmer can sell his harvest at a good price, supporting his family and community. But when China's economy slows down, the demand for soybeans drops sharply. Suddenly, the farmer finds it much harder to sell his crops. Prices fall, and he earns less money. This doesn't just affect him, it impacts everyone who depends on his farm, from workers to local businesses. Or, think of a family in Nigeria that relies on jobs in the oil industry. Oil is a major export for Nigeria, and when global oil prices fall, companies start to struggle. They may be forced to lay off workers or even shut down operations. This means families lose their main source of income, and entire communities can suffer as a result. In Europe, car manufacturers often export vehicles to China. If Chinese consumers stop buying as many cars, European factories may have to slow production or cut jobs. Workers, who once felt secure, may suddenly find themselves unemployed, and local economies can take a hit. Retail shops in the United States also feel the impact. Many stores import toys, electronics, and clothing from China. If Chinese factories shut down or face disruptions, American shops might see empty shelves or higher prices. This can frustrate customers and hurt business. Restaurants that rely on imported seafood may see prices rise if trade slows or shipping becomes more expensive. Chefs might have to change their menus, and customers could pay more for their favorite dishes. Even students can feel the effects. If their parents lose jobs or face pay cuts, it can become harder to afford school supplies or extracurricular activities. In some cases, government scholarships or funding for schools may shrink, affecting education quality. Banks and investors are deeply connected to these industries. They lend money to businesses around the world, hoping for steady returns. If a bank has given loans to an oil company or a Chinese business, trouble in those sectors can mean big losses at home. Investors may worry, and financial markets can become unstable. These real-world examples show just how interconnected our world is. A crisis in one country can spread like ripples in a pond. What starts far away soon reaches every corner, affecting people, businesses, and communities everywhere. Governments and central banks often act to stop a crisis from getting worse. They may lower interest rates to make borrowing easier or spend more money to create jobs. Some countries join together to support troubled economies, lending money or forgiving debts. Companies can try to find new markets or make different products. Workers may need to learn new skills for changing industries. People can save money and avoid risky investments during uncertain times. But these actions take time. Not all countries agree on what to do. Some cannot afford to spend more money or lower taxes. If the crisis is very big, even strong economies need help from others. The world must work together to find answers. A double crisis, an oil shock and a China crash, shows just how closely the world is linked. Problems in just two places can affect everyone. For people everywhere, it means being ready for change, at work, at home, and in daily life. Some experts say the world will recover, but honestly, it may take time. New industries may grow and countries may learn to depend less on oil or a single trading partner. Until then, families and businesses will need to plan carefully and watch the news closely. What happens next depends on the choices made by leaders, companies, and all of us. The world has faced crises before and learned to adapt. By understanding the links between oil, China, and the global economy, we can be better prepared for whatever comes next.